Splashcreen. Wake up, motherfucker.
Yo, okay, what's up? What's up, guys? I don't know, StreamYard's acting funny because I don't know what's even going on here. Whatever, I don't know, StreamYards or what the fuck? Wi-Fi, StreamYards, I don't know. See, but I already told people to buy oil over a month ago, so I don't know. Oh, you just finished my last live? Well, what's up? Welcome to this live. So did the intro even play correctly? Because it kept going in and out for me on my side. I was just like, what the fuck is StreamYards doing? Man. Bro, I don't understand why like they got bought out over a year ago and now they complete all this stuff and I keep like seeing bugs and everything. Man, dude, I don't even care. Oh, I don't even care. God damn. Do I have to learn OBS or something? That means I have to get a real computer finally after all these years. Shit. Anyhow. Okay, let's get to it. Let's get to it. Let's get to it. Oh my god, where the hell is the thing? Da 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 da. Okay, play this shit. Oh, all right. How come you can't see HB? Well, because I multi-stream, bruh. You gotta subscribe to all my and YouTube. I'm on John Galt's channel. There you go. We'll look at the banner. All right. So, where were we? Where did we leave off? I said, yo, nothing's gonna happen until Friday, and then still nothing is gonna happen. It'll be Monday, right? What did I tell you? So, we went down after Powell talked, and we kept going down overnight. And then what happened when the market opened today? It tried to recover. It tried to recover the whole day. It didn't let it drop anymore. We're still at the cliff's edge because the options market controls everything. The options market. There you go, guys. That's what I told you. So don't believe anything that happens this week. Only believe what happens next week once all these options get cleared out of the system. And then we'll finally know where the S&P, the NASDAQ, not Bitcoin and Ethereum, though. Sorry, guys. You're going to have to wait another week because your options don't clear until next Friday. So you're stuck at 75,000 over there. What about last week? Last week was fun. I don't know. Oil, go trade that or some other shit. Whatever. One thing interesting was to short gold, right? Silver. I didn't talk much about that because that's not really something you want to trade unless you have control over the overnight markets, essentially meaning you have to trade futures. If you try to do short-term trading on gold and silver and you don't have access to overnight trading, you're at a big disadvantage. Okay, that means if you're using options, you only have like what, an hour or so before market opens and after market opens, but all the action happens European Chinese time, man. So sorry, most of the fun happens then. By the time the market opens, it's probably like almost done, or you're gonna be scrambling trying to get out of a position, and you have to basically guess what's going to happen overnight every time you do it, which is very painful to do correctly, and you might get burnt. All right, but I'll talk about it anyway. Let me bring up something because that's the title of this stream. why did I say all that time that gold and silver is going sideways? You know, there was a reason for it, but there's even a bigger reason now that the oil has been going up and natural gas too. All that stuff affects things, right? Energy prices essentially affects how much it costs to mine gold. So if you're in a miner, it's not free just to dig the earth, right? You're not doing that. You have to pay energy costs to ship the silver and gold. You also have to pay energy costs for the equipment to mine the gold and silver. So that is what's going to kill it. So along that premise, you also have the dollar going up, and that's going to affect gold and silver prices, right? And then we also have bonds yields changing. That is also going to affect gold and silver prices. So all of that combined makes it very bad to own silver and gold miners. I believe I have a video about that, so I can let Samantha talk to you in more detail, but I believe you understand what I mean. But I think the most important thing is that inflation is coming, and it's going to get really bad next year. So let's go look back at this thing here. 3-month minus 2-year yield. I warned you that if this thing goes any further down, it's like basically we're re-entering the 2022 bear market. So whatever happens here will occur several months after the fact. The bond market is smarter. They know everything ahead of time. So if this holds, and then whatever we have with Powell, because yesterday Powell talked, and I knew that he was going to do an FU to Trump, and he basically did that. He did an FU to Trump. It wasn't that he raised interest rates, but he said, like, I'm going to stick around even with your new replacement. I'll still be part of the board, because traditionally, the Federal Reserve chair, after they get replaced, they leave the board. But based on the rules of the Federal Reserve, you could stick around. So he's going to stick around until his term as a board member doesn't end until 2028. So he could just stay there, sit on the board, and influence the other members of that board just to fuck with Trump for another 2 years until Trump is gone. Oh, man, that means the Federal Reserve will be a big question mark. And you know what? The market doesn't like that, because that means uncertainty. All right. So it's good for trading, though. You can trade that all day and night. All right. Somebody on StockTwit say the same thing as you. Don't believe what happens tomorrow because of OpEx. That's why MU went down today. Yeah, I don't know. MU, Micron, the thing about it is it already went up like 100% since the last earnings. Like, you have to really convince someone to buy Micron at a higher price than it's already is, right? And once you have all these bond rates being changed, they're going to reprice all the tech stocks. So if they're convinced that the Fed is going to keep rates for higher longer, which is what already happened yesterday, essentially we won't have the first rate cut until June of next year. Or not June, wait a minute. Is it June? Yeah, something like that. It's that long. It used to be that we would have a rate cut in a couple months, but that's gone. The probability of a rate cut staying that high has already went up. If this sticks, then they'll reprice all the stock market, because the stocks have to compete with bonds, right? If they look at the bonds, they go like that. And then tech stocks, they don't have any dividend. Okay, most of the tech companies don't have dividend anymore, or if they did, they very tiny dividend. And also software companies which rely on growth, growth gets affected by higher interest rates, so that takes into account. So then they'll reprice everything lower. So if that sticks, that's what's going to happen. Okay. Can you show how to gauge with your chart what's a good buy price? No. This has nothing to do with oil. Nothing to do with oil. All this does, it tells me when the general broad market, S&P 500, NASDAQ 100, is going to have trouble. That's it. It doesn't tell me if oil is going to do fine or Dollar Tree or this, that. No, it doesn't. It doesn't tell me nothing about that. That's its own animal. Okay. If it was that easy, then everybody could do it. That's why they pay people money. Essentially, you have to do what you have to do is you're gonna have to have a team of people, like a team to just look at oil and gas stocks because they all have their own peculiarities. And some people to look at tech companies, and tech companies have their own different types, right? So, and industrials and staples, banks. That's why one person can't do it all. And that's why I tell people to use charts, because charts is an easy way to do it quickly without a team of people. You can just open a chart like this and kind of go like, okay, I see where things are going to go for the broad market. Then I have to look at another chart, figure out where oil and gas wants to go, and blah blah blah. I just use charts. I don't have time, and I don't have the resources of people to run around and look at what this guy is doing, that guy is doing, and stock pick. You know what I mean? You can only use the tools that are the most efficient for you. And I feel charting is the most effective tool. It gives you the picture really quickly because everybody can look at a picture. They don't need to read words. They don't need to read thousands of SEC reports and papers and blah. And even that's not going to help you because the SEC report is public, meaning that the market already reads that stuff the same as you. You have no edge, right? And that's why I don't like fundamentals, because fundamentals essentially means that you think you see something that someone else doesn't see by reading the public available information. So the publicly available information is free for everyone. So the only people with an edge in that score would be people that have spies in companies, so corporate espionage. They have insider trading. So basically, I'm going to be a Nancy Pelosi or something. Or I'm going to be cheating, like directly manipulating the market, essentially being a JP Morgan or a Goldman Sachs. I have none of those edges. So charting is the quickest and best way to evaluate quickly and do it in a manner that I can make money, at least by beating idiots. All I need to do is beat an idiot, because not many people will be looking at this chart, okay? I know some people will know this, but most people won't. So most of the morons are still in the S&P 500 right now, and they don't see this, and this thing will go down if this thing pulls more, right, in a few months' time. And so maybe around July, August, this thing will crash hard. There will be some kind of crash probably next week, if it does happen, but it will be very short. So probably 1 to 2 weeks. You buy the dip, it'll go back up. It'll trick people in July that they think everything's fine again. And then August, sometime around August, September, something goes wrong and it'll just collapse into October, November. And that's when you buy the dip again. And then we go into 2027, and then that will be the big crash. That's what I'm guessing where things are going to go. So that's my prognostication right there. All right. I'm thinking of buying a storage company ETF, PSA. Is that a REIT or something? If that's a REIT, okay, I'll look into that. I don't know. I never really looked into REITs, but if the REIT sector is improving, anything with that has to do with digital storage might be good. Maybe. Okay. Anything else? How about Bitcoin? Bitcoin's gonna go to 90 or 100K if it survives next week. It has to survive 2 weeks though, maybe 3 weeks. It's ready to go to 80 first, and then if it breaks out of 80, 85, then it's an easy road to 90, 100, trap people again, and then it'll crash pretty shortly afterwards. You can short it once it hits 90 and 100 if you want to short it. Fundamentals tell the truth. I know it tells the truth, but when does it tell the truth? 20 years from now. I can't wait 20 years. So, I mean, that's fine when I was around because I invested in the 90s. I can wait 20 years because we had a bull market in bonds. The bond bull market started in the 80s. So you had the bonds help you out for 40 years since the 80s. Now you don't. So you kids, you don't have the benefit of globalization and an endless supply of money from the Federal Reserve. Those days are over. We're entering the era of permanently high inflation, in the era of high bond yields, we're in a different time. Okay, we're in a different time. That's what I'm trying to tell you guys. You know, you can wait for the next 40 years before everything returns back to where it was when I grew up, but by then you'll be too old, right? That's the whole point of this show. It's to show you that there's different situations, requires different tools. Okay, different tools for different situations here. We are now in a permanently inflationary environment where gold is dominant, silver is dominant, stocks are kind of like meh, and who knows about grain prices. I'm looking at corn and wheat right now, if you can believe it. I'm like, holy shit, maybe corn and wheat look like pretty good investments right now. Soybeans. Anyway, kind of REIT, I think. I heard storage is good, not digital storage, real physical storage, like space storage. Maybe someone mentioned this to me before. Someone else mentioned to me like a storage space stuff. Man, I gotta go find my list again. Yeah. Where's everyone watching right now? They are on Urban Landlord or my channel or Kick. I don't know. Wherever you guys come from. Yeah, so you can go give crack to me on Kick and YouTube, or the Urban Landlord, John Galt's channel on YouTube. So you got there. All right, so that's kind of what I'm trying to say. Hopefully you understand what I'm saying. I don't know. Maybe it'll take time for you guys to believe what I'm saying. But anyway, here we are. So, again, oil follows gold. Gold goes up 19.8 months, shifted, so about 20 months ahead. And gold is telling you that oil was going to go up, and we are moving up. But now it's time to talk about another one. This is shifted 15 months. This tells you when corn, wheat, soybean, oats, so your oatmeal is going to go up. And we are going to hit a peak sometime around May 2027 if this gold is really making a peak here, and we're going to go sideways for a while. Then yeah, we will peak out sometime around June of 2027. And oil itself, as I said last night, sometime around October, November 2027 will be oil peaking. So gold predicts inflation. That's what I'm telling you. Gold predicts inflation after a lag. I have been seeing a lot of people in the video just on YouTube. They've been like screaming all this stuff about gold and silver and this and that. They think like war is good for gold and silver. Yeah, that can be true, but people have already been buying a ton of gold and silver already for inflationary reasons. And so you're going to have to convince a lot more people to buy gold and silver for a World War III situation, because whoever was buying gold and silver for inflationary reasons probably are the same guys that want to buy gold for that reason. And they already bought enough of it at cheaper prices than you. So you coming in at the last minute whining that you bought gold at the top is not helping. It's your problem. You bought it at the wrong price. The big boys who were getting ready for this type of scenario probably already bought it and are not willing to pay $6,000 for gold. They bought it at $3,000, $4,000. I told you guys to buy gold and silver like 2 years ago or some shit. And it's like, dude, boomer rocks, right? Well, whatever. Too late now. So forget about gold and silver. I told you guys to buy oil last month. That's where you should make your money. Come back to gold and silver next year or some shit. I don't know how bad it's going to get. But anyhow, so I'm looking at soybeans, corn. here. So soybean oil, soybeans themselves, soybean meal, and corn and wheat. All of them look like going to go well. And if you want to buy an ETF just on grains, this probably won't make you a lot of money because it's just like a straightforward ETF, no leverage. But if you have a boomer portfolio, you might as well toss it in there. And this one doesn't issue a K1 tax form. I hate it when these commodities, ETFs and gold and silver futures leverage ETFs or natural gas or gasoline ETF. This one doesn't have a K1, so this is nice. It'll keep your TurboTax happy or whatever the hell you use, or Quicken. I don't know what the hell you guys use. But if you have a K1, you have to do things manually. That's the annoying thing about K1s, man. You got to enter all that shit and figure out how to like make it work for your particular situation. Okay, so PDBA does not issue a K1. It's an ETF, and I guess it's a combination of corn, soybeans, and wheat. I don't know, something like that. So PBDA, we got this one. So let's look at the long term. Let me look at the monthly here. So it looks like it's starting to perk up, and for some reason, the volume this month has been huge. So 3 million shares have been exchanged. Oh man, you know when there's a lot of volume, I'm liking it. Something's happening. So get ready for high food prices next year. You're gonna have to be eating that, or just get on welfare. Just get on snaps, because you really got to get on snap, because this is not gonna be fun next year for sure. We have other ETF here. It's called Veggie. I guess these are the makers of food products. I'm not sure if they'll do well in inflationary conditions. So I'm not 100% sure this is a good place to be. I know that the food itself is going to go up in price, but if the food manufacturers don't want to pass those margins onto consumers and eat the loss, then this might be a bad place to be. But I guess we can't tell yet, right? Because we haven't been here since the Ukraine war started at this level. So maybe this is a good place to be? I don't know. Gold is priced out of the retail market. It's done. Yeah, I played the video where the moron sold silver at 35 and he bought it back at like 100 whatever of troy ounce. Morons, man. There's a lot of morons out there. And this is why it's easy to make money in the markets when you just need to beat the morons. I don't need to beat Goldman Sachs or JP Morgan. I just need to beat the average bear. As long as I know that, I can at least get something from the casino. So that's it. I got fucking smashed there. I'm a small business owner in the physical metal space. Oh, wow. So the guy that I played a clip, he went into the store and they told him, you can't sell it back to us if you buy it right now. So he bought that. He sold it at 35 some months ago, and he comes back and buys it at 100 something. Like, what the fuck are you doing? Oh, shit, that's crazy. The divide between paper silver and retail silver has never been more divided. Yeah, I'm sure it is. So my mom dumped a lot of gold on the run-up. So it's junk gold. So she had a lot of scrap gold, which would never sell at good price. But as gold was going to 3,000, 4,000, it was like, yeah, time to dump it, If you wait for the top of gold, it's probably hard to sell at that point, any kind of gold, right? So you can't, that's the funny thing in the physical market. When you go outside to buy and sell, it's like you can't wait for the actual peak to start selling it, because nobody wants to buy it at that price. Anybody sane, only dummies will buy it at that price. And so you have to kind of sell it at a suboptimal price as the run-up is happening in gold. And as far as silver, I couldn't even imagine, because silver likes to do this, right? It goes nowhere, and then all of a sudden it just flies up like a bat out of hell, and you're like, well, who's going to buy it from you now? I don't know. So Goldman Sachs and JP Morgan are offering hedge fund clients ways to short the $1.8 trillion private credit market. Oh, that's nice. That's nice of them. Sounds like more volatility's coming down the pipe. Oh, great. How do you just? I can't decide that. It's like, here's the thing. If OilU is based on 3 ETFs: XOP, XLE, and OIH. Okay, 3 ETFs is where you're basing your pricing on. That's it. That's all I got. And if I look at OIH, which are the refineries mainly, let's say, and OIH is the reason OilU is overall has a weaker performance than Gush and NRGU. And today OilU had a better performance on the day because OIH actually went up 2.41%. So it's tough, right? Because if you look at XOP is already at resistance. XOP is already at the resistance. We already here at 175. So we're here. If you look at XLE, however, it already broke out. Like XLE already broke out of this range that was set way back in the top of the great financial crisis right here at $44 on this. It's already broken out. So you got 3 signals right here. One of them says like it can fly forever. One of them says we gotta stop now. The other one says, I don't know. We are undecided. I want to go sideways. So that's not going to be easy, right? That's not going to be easy. And that's why I said, like, I don't even know if I really want to decide anything yet. But for now, I pretty much have said 2/3 in NRGU and 1/3 in Gush. So let's look at the overall performance. So NRGU, let's look at the weekly here. 42%. Okay, from when I said buy some oil stuff. Gush is about what, 34% since I said buy the, and OilU is about 21%. You see the weakness of OilU right now compared to Gush and NRGU because it has too much of the Halliburton and Schlumberger. Schlumberger and Halliburton has a lot of issues with being part of the Qatar and whatever is going on over there, I guess. Exactly. Crack, the run-ups completely broke the supply chain from small business to refiners and wholesalers. Underwriters have screwed everyone. Man, I can't even imagine working in a real business. What is the future of lube? Oh, okay. So you want lubricants. Lubricants will probably go up in price. Yeah, so anything that's petroleum-based will go up in price. So you better find some other ways to lube up. I recommend you just take a stick of butter and start melting it. That'll be cheaper, probably. It's always based on... I just use the ETFs as a proxy. It's not really based on any one particular ETF. Gush is directly based on XOP. Gush is defined by XOP. OilU, NRGU, WTIU, those 3 are some made-up composition that they arbitrarily made because it's a Canadian bank and they made those ETFs. So I have no idea where that came from. Tropes. Wish I could get in on that. Oh, you wanna get in this thing? Oh yeah. These are probably special clients here. Yeah, what's up, Gary? All right. What's the other way to make petroleum? You can take coal and turn it into petroleum. That's another way. So if you got some coal with you, you can use the German process to turn it into petroleum, and then you can turn that into lube. That's how you make your synthetic oil. I think the only way you're gonna get exposure to it is you have to have a huge ass account with them. So basically, you gotta be a billionaire, I guess. I don't know, because if you can't get into the private market, essentially like you have SpaceX shares or something, you're not gonna be able to probably short the same freaking thing, right? They've been hitting each other refineries, so that's why I jumped. Yeah, I don't know. I thought refineries being shut down is bad because Halliburton can't sell that gasoline and diesel that they got over there. So I've got no clue. I can't tell. Like I said, I just look at charts and I just see the signals from there. I go like, oh, is there a story here? Maybe. I just see this being weaker, so then I don't want to be in this ETF no more. I'm gonna be in the other ones. So that's how I decide things. I don't need to look any further. Just follow the chart. I only make money on the price, right? I don't make money on a story because the story can change at any moment. So I can only base on that. Because somebody else, I assume, is smarter than me, and it will reveal itself in the chart. So that's it. That's why learning to read the chart correctly will be at your advantage instead of wasting time reading a lot of articles and stuff, because AI can do that for you anyway, and AI will go directly to whatever trading desk Goldman Sachs has, and that guy will press the buy and sell button, or they already have bots doing that anyhow, and they have all the mathematicians doing that, so it's very hard to beat them. So the best bet is just to be more knowledgeable and understand how things are going. All right. Do I need to look at this? No. I think I want to look at GDX. Okay, so here's the problem route. This is bad. This is a bad week for gold miners. This is bad. We dropped below this pink square I drew, or rectangle. This is not what I wanted to see, because that means that this has the potential to make a larger range, meaning that it can go between 113 and 66 and go back and forth for the rest of the year. A larger range is great for trading if you can time it right, though. That's my question. So if you want to decide to trade this using ETFs, then you can do so. There's GDXU. So if you think it's done selling off here, you can go GDXU and wait for it to go back up. So let's go at 158. Maybe it can go back up to 300. And then when it gets up to a certain level, you can sell it, short it with GDXD. So this is the dumb man's version of longing and shorting. So yeah, there we go. So the last 2 days, if you were in GDXD, you probably made about like 50 to 60% if you timed the bottom and high. So there you go. Yep, that's how you do it. But like I said, I don't like recommending this, because any type of trade where it's short term, I think you're better off learning how to use futures and shorting and longing silver and gold directly, because you have the whole 24 hours to trade rather than shorting and longing using this ETF. If you have Robinhood or maybe even interactive brokers, they might allow you to trade GDXU and GDXD overnight. So you might want to look into that instead. So if you don't want to learn how to use futures, because it is kind of tricky to learn how to use futures when you first start out, you might want to look and see if Robinhood lets you trade this overnight, or if Robinhood doesn't, then see if interactive brokers let you trade this ETF overnight, because both of them has a bunch of tickers that they allow to trade overnight. So essentially nearly 24 hours of trading. Okay, so if you really are a junkie and want to trade this huge range, because it could be a very big range. Okay, every time oil gets happy and it crashes gold and silver, then great, you can short it for 50% down and then long it 50% back up when oil pulls back. this is probably a better way to trade than actually trading oil. You can just trade this, but you know, you're not only looking at oil too. You know, you have to look at the dollar. So you have to watch this. You have to watch the dollar. You have to watch the Japanese yield. You have to look at the U.S. yield, and you have to look at the Chinese yuan and Japanese yen. So maybe it's not that easy, but roughly it's going based on what oil does right now, and natural gas too. Put that in there, and not the U.S. natural gas. I talk about European natural gas. You have to look at the Dutch natural gas prices. The Dutch natural gas prices is very different from the U.S. I don't know if TradingView has that on here, but let me see. Dutch TTF, is this it? Yeah, you see this? This is what European natural gas looks like. So $28 up to 61. Is this in dollars? I guess this is in dollars. Oh, euros. Okay, 60. So 28 euros to 62. Gasoline, I mean, crude oil is pretty much priced in dollars, even in the UK market, because that's how we keep our dominance. Natural gas, however, can be priced in anything. We didn't tell people that you have to use dollars to trade natural gas. Okay, so U.S. natural gas is essentially this NG. So it looks like this. Very different. See, it had this spike when we had the huge storms in the winter, but that leveled off. But overall, U.S. natural gas prices, we're fine. We don't care about the Middle East for natural gas. So we're okay with natural gas. Only thing we have to care about is oil, because oil is a global commodity and everything is priced at a global price. So sadly, that's how it works. Okay, and I guess we created it that way. That's why people need dollars, because they have to use dollars to buy oil, unless you are one of those rogue countries that start using gold, yuan, reals, or whatever the heck people want to do. So yeah. All right, there you go. Now you understand, right? But let's look at gold itself. It looks fine, honestly. Even after this drop here, it's still in the trend. You see the moving averages. So if you look at the weekly chart, it's fine. The only problem now, though, is now we're below this yellow zone here, and if it stays and lingers below this yellow area without recovering anytime soon, the longer it does that, there is a risk it could just roll over into 4,300 or something, like on this purple line down here, and then freak people out if it drops below that, and it's possible that could scare people. I don't know. How about silver? Silver's looking bad, I think. It looks worse than gold, but it's still close to that moving average here, so it's still trying to maintain it. But I don't think silver's really gonna make a meaningful recovery, because if oil stays where it is and the global economy goes down, then yeah, you'll have to look at copper too. Copper will probably not be good. Yeah, copper right here. Yeah, I think yeah, you're gonna have to see how that goes. Okay, hopefully you guys understand that. Let me play the Samantha Leduc stuff. Okay, let me play the video. We'll see what she says. So I gave you my analysis. She's more professional, and she's more knowledgeable. So let's see what she says.
This short clip is from my live trading room. You can engage directly with my fabulous team and me at leductrading.com for all our research and trades, or for just my daily live streams you can access via YouTube memberships.
So yeah, if you have a lot of money and you need professional help, more one-on-one attention, you need someone to like freaking guide your hand. She also has a Discord. She has a team of people each team specifically handling different sectors and things. So, like I said, I'm just a one-man show. You actually need a professional outfit to actually give you a personal attention. So if you have a lot of money and you need someone to tell you how to navigate the next decade, you probably need help like this, because I don't think it's going to be easy the next 10 years to figure out the markets. We've been having it too good, all right, the past 40 years. And we are going to have the 250th birthday of America. And guess what? 250 years is the average lifespan of an empire. So we might be at the peak already, guys.
Links are in the description. Yesterday, I was talking with a client about gold and silver, specifically demand for metals during an oil crisis. And this is not my work. I'm going to share it as soon as it's finished. But client Jose put together some fabulous research and sent it to me this morning. So I'm formatting it, reading it. And anyway, a lot of it, yes, is Claude based, but I'm going to get to a point about why this matters. His specific focus is on global automotive industry and the oil price sensitivity, and he is in the automotive industry and he's a precious metals trader. So he combined knowledge of both and then gave some really good precedents of oil shock episodes and how it impacted the global auto market, specifically regional differentiation, obviously US versus abroad, demand elasticities, short run versus long run, transition channels, what happens obviously when crude prices rise and how it affects ICE vehicles via the EV hybrid market. This is all his research, but he shared it with me this morning. Forward scenarios, what happens at 100 and 150 Brent, that's sustained. And as you know, I have this strong conviction that we have a sustained or protracted Middle East war. So he goes through with some predictions, and obviously EV will fare better for ground transportation. Just remember, jet fuel does not have any EV equivalent. So client Brian in the refining space reminds, in particular, California is going to get hit quite hard. Anyway, so these are some clients that shared their expertise, and I have not finished this, but the point is we've got some examples here of how oil not just impacts the automotive space and the conclusions that he drew, and we were talking about this yesterday, but specifically its impact, how it channels into palladium and platinum, obviously, the inputs used for catalytic converters in internal combustion engines, and how oil demand starts to fall with miner demand, which seems like, what? Yeah. So the energy expense we've talked about a lot as it relates to 40% of the operating budget of most metal miners is energy. It's even higher than airlines. But the point is, when you start to have the ICE or the gas vehicle demand fall, and with it financing, gas prices rising, hurting consumers at the pump, you also have a dislocation in regards to palladium and platinum in particular. It actually is a double whammy. So you not only have the miners impacted greatly by the higher energy costs, so margins are constricted, absolutely, but you also have demand which falls in, especially again, palladium and platinum that is tied into the automotive sector. XAU USD, this is gold and silver. This is on a weekly, just so you know, and some lines in the sand that are very important. This was monthly. Critical level of this 47.80. That had been a price target that I had given in June of last year. So literally in June of last year, I had given this level for XAU USD. We reached it, we got above, and then I warned January 28th and 29th of this year that we were going to have some metal volatility. Gold ended up coming in 16% and silver 39%. Long story short, we have definitely started to digest and start to flip lower. We broke already the 10-week even before today's PPI hot print. So keep this 47.80. We get below that, we're heading down to 45.50 and then 43.80 40.80. We'll look at the heat map as well, but we're already at this morning. Basically, there's 48.20, which is not so far away from this line in the sand down here. Just keep that in mind. I think that's where we're going to go. So let's do this right here, right down here. So I don't think this is done, even though it'll get defended in the short term for a little bit, maybe bounce a good 40, 50 points potentially, but at some point we're going to head back down to this 47.80 in XAU, and you can do the same thing with silver. You can see how they are falling intraday this morning at the 100. We literally just looked at that. The more time they press, and the fact that we've already gotten below the 10-week and we're softening. I still have silver 61. This 61 that never got filled on real-time trading hours. It's headed there, big picture. I don't know if you recall when we had the big volatility, we actually had a 39% drop peak to trough, and it literally tagged this 58.5 level very, very briefly after hours, and then 61. And I remember because client Kirk pinged me and he's like, what's 61 your level? And he ended up brilliantly trading this from 61, I don't even know what, to like 81. It was so smart. Anyway, long story short, I said then it will revisit 61 during regular trading hours. RTH, that's it. We've got, I would say, this in play. So even though it's 69 right now for SLV, don't be surprised to see this roll over into 61 and tag that ghost print. In other words, it's a memory in the system, but it isn't today. Gold has done its job, and we literally just talked about this yesterday. So I mentioned this was a head and shoulders, and the first price target, this is, or was it Monday, Tuesday? I don't remember, but the point is, we're right down here on this channel. See this big old channel right here? Okay, so we got this little head and shoulders, and it has started to come back in, and I said, don't be surprised when we come down to 4,600 area in this particular dollar strength moment. Dollar strength moment could get very busy. It could actually move from 100.5. That's the trigger it needs to get above. I showed you that yesterday. It could get all the way up into 105 in time. I think that's more of a between now and March timeframe, where it also aligns with my equity headwind time frame. But the point of the matter is we got this little head and shoulders on gold continuous right here, and we're on the top of this channel where we had the big old shake and bake, but we very likely have a little bit of defense here and then a rollover. I would put your sights on that 4,600 area for better support, or I should say buying, for those who want to get involved again. I think that would be a better location. Silver is just starting to break below 78. You can see 70 is in line for silver futures. And yes, this is shake and bake. This is my reversion to mean, geometric mean, I should say, and it is coming back into the 10-month. So this is weakness in the precious metal space. So speaking of metals, literally after I went through my intermarket on Monday, which I showed you, and I'll re-emphasize my gold miner bullish percent index chart, I grabbed these charts. But first, let me show you that bullish percent index chart again that I went over yesterday. Here it is. This is important because I think a lot of folks are playing, present company included, in the miner and precious metal space. So you've got a situation where, remember my warning, cannot get above 100. That's just, this is an oscillator. Very, very oversold. You buy, very overbought, you be careful. And you can't get above 100. And then boom, right in the kisser. And that happened twice. Once in October when I warned, and then again, January, we caught it live. The point is, this indicator is obviously falling. So this yellow needs to catch up. So that means there's going to be some basing activity down here. If it's above 80, it's very strong. It's bullish. Yahoo, ride it. It's a beautiful trend. And you can see clearly, hopefully, back in March of 2024, this thing hooked around and got very, very, very bullish, and then stayed very, very, very bullish. And the point is, it's not a game of perfect, but it shows the bullish percent index for miners really, really has a fabulous kind of turn here every time it gets this inflection where the indicator goes up against my cherry picked indicator, which is this yellow line over here. It's very bullish, and then we stay up here. So we had some shake and bakes, but they kept getting bought, and we kept going into overbought territory. But this one looked very different. We had a huge 100% can't get above dump, and then we had a bounce, but not a very convincing one. Even if IV went higher in the options, the underlying price did not move up. Everyone kept giving all the examples of higher silver demand and falling supply across the board, and this rotation basically stabilize. So I know that's a little hard to read, so maybe this isn't as hard to read. Here's gold. It looks perfectly fine. It really, really does. Beautiful. This is the strongest. This is why I keep saying gold is definitely stronger. It is on a monthly and it is above the 10-month. And this is literally your mean is right down here. So what you're doing is you're protecting into this GLD kind of 390 area, because this can come back down to the mean before it's safe to base and move higher again. That's GLD. It's definitely the strongest. I'm just showing you in the paper markets. Here's silver, definitely the weakest. Absolutely the weakest. Look on a monthly again. This is very important. We had the big 39% shake and bake. It doesn't appear like it's a big deal, but when you put it on a monthly, look how close it is coming into the mean, which is about this 80 area. So this is the silver miners. Look how big that rejection candle is, even before today's pre-market sell-off. This is why I've been spying this. We're heading lower. Here's another example. This is SILJ. This is heading back down into the mean, which is about 26 area. And here's JDX. This is monthly again. This is a huge reversal candle of size, massive. So it's a safer bet once it comes back into this kind of 109 area, and it can prove that it can base and turn around and move higher. But right now, this rotation, you've got JDXJ, JDX. This is again on a monthly, big picture for sector rotation plays. SILJ for the juniors and SIL for the silver miners. All right, so this is your silver, huge exhaustion inside for February, pretty typical when you have a big 39% move peak to trough. And then this is the weakness. Now it's inside and it's starting to break down. It's starting to break below the December high. And that's just what typically happens when a parabola breaks and then it peters out and it comes back down. This one looks very much headed to that 58 area. All right, market's getting defended on this PPI print as expected. I'm talking equities. Right now, I'm focused, just so you know, on some of this drama that's happening in the precious metals space, because I see falling prices into the 10-month EMA for silver, for gold, for miners of silver and gold on a monthly. They're all pretty clear that we have some big reversal candles in play. The miners coming back down. They broke already the 10-week last week. These are the silver miner juniors, gold miner juniors, silver miners, gold miners. But the point is, these are the ones that are leading to the downside with silver and with gold. So even though silver SLV is 69, I still see 61. I can't get that out of my head. We went there once, we can do it again. So take care on the weakness in the silver, gold, palladium, SBSW. So client Jose was talking about this, but it was ironic because on Monday I had sized up palladium platinum parabolas that had started to burst. SBSW has a relationship into that space and ironically follows very closely, as I will share with you later from Jose's notes. And I haven't finished reading or structuring this down here. Long story short, it's negative inversely with oil prices. So very important to kind of keep that in mind. Miners are hit, but it's a double whammy for SW because it has a strong correlation with the auto manufacturing space. And look at this trend line. So this was the big shake and bake back in end of January, has rolled over officially 2 weeks ago, last week. And now look at it, it's just precariously perched. Does not look bullish. Miners are under distribution. So really be careful if you're long, which is tough. But as it relates to miners, this theme of pullback is in play. Gold is the strongest, for sure, for sure. Palladium and platinum are the weakest, for sure, for sure. But all of this I'm showing you on a big monthly candle, and we're only halfway through March. We could have a bounce, but I would still expect this monthly mean to come into view for all of these miners, because they have stopped going up January, February, and then March they tanked for obvious reasons, Iran, oil, etc. So,
all right, guys. So, I don't know if you remember, but I talked about auto industry because Larry Williams had a cycle chart that I shared with you guys. And he said the auto industry was at a peak. And now that we got all this oil stuff, now we know why that would be a peak. So, let me try to get this stuff here. Okay. So, I keep telling you guys, there are cycles to everything. And I don't care about what the reason is that this is true, but as long as you know the cycles, you will know the future, essentially. You just don't know the reasons why that will happen, Maybe it's the sunspots, maybe it's the gravitational pull of the moon and the sun acting together. We were talking about that recently. In some streams earlier, and then the last stream I talked about the sun and how it influences human behavior, and also they were talking about the hurricane seasons influenced by sunspots, and probably that will affect the grain prices. So the great thing about cycles is that we can figure out what's going to happen right away without caring why it's going to happen. I don't care. Some scientists will figure that out some other time, some way later. I just need to trade. I just need to make my money now. I can't wait for scientific verification, right? We see it. And it looks like, for some reason, we know that the auto industry has this 13-year cycle. This is what Larry Williams found. And we peak around here in 2026. And I guess that really might be the peak. If oil really stays quite high for a while, we are peaking right now. We might, keep it going into the end of 2026 before things fall off. But yeah, by 2027, the prices of cars will fall off. Okay, so this is basically the total vehicle sales. It has a 13-year cycle. And yes, that's it. So if you want to buy a car, probably you can wait until 2035 if you can. Because that's probably the cheapest price you'll get on a car is 2035. If you got a used car, well, you should have sold during COVID. COVID was a great time to sell used cars, but if you need to dump that car, you probably should dump it now and get your money if it's still worth anything. So that's it. And now I guess now we know why. Because oil is going to stay this high for some time. So that's probably it. If we look at the 6.3-year inflation, this was a year cycle in inflation. This is what Larry Williams was like 2027. And this aligns with what gold has been predicting. Gold predicts inflation. Okay. And this syncs up with that. Now, this is why it's so important to know that things happen with delays. All right? Something happens doesn't mean the other thing is going to happen at the same time. It's not always true. All right? And so you should act accordingly. So, let me read this. Like maybe you guys need an analogy. Why delays happen? They happen in real life too. Okay? When I was an engineer, we have to take care of delays. Delays affects the system. So you have a cell phone, right? There's a lot of signals banging off the walls of buildings. This is why when you're in a city, you have a lot of problem getting signals. Okay? So it's not only being in a rural area, it's also being in a city full of skyscrapers, because there's a lot of signals bouncing off the same walls, the same steel and glass buildings, concrete, whatever, I don't know. And they bounce and reflect and come back to your phone. And this affects the delay. okay, of the signal. And why does that matter? Because when you get your signal, it's from multiple antennas. And these multiple antennas can be anywhere, okay? And they come at your phone at a different rate, all right? And at a different time. And after bouncing through so many walls, they could actually cancel each other out. So that's why you have little dead zones from time to time in a city. So you need to take that into account, all right? And when you're trading, you also have to take that into account, because you have to understand that gold will move, maybe not today, but maybe in 3 months, or silver or something like that. Same thing with ball time down the road, but might not be right away. Who knows? Maybe it is right away. I don't know. It really depends. So people that understand this stuff probably make the big bucks in some big trading house or financial center somewhere. And that's another reason why not only they hire physicists and mathematicians to do all the big equations, they also hire engineers. Yeah, I did get offers for for me to move to New York City and work in a finance center and whatever. And I was just like, ugh, do I want to work for Wall Street? It's like, they didn't offer me good pay, honestly. It was like, dude, you're offering me the same pay I'm getting in Silicon Valley. Like, why would I go over there, work in New York City? You better give me coke and hookers, bro, because I ain't doing that shit for just like, honestly, you better give me some crazy benefits package, because I ain't going on to New York City for this. If you're gonna pay me the same base salary, fuck that. So anyhow, yeah, that's why they would hire engineers, because engineers do a lot of modeling, and I'm guessing those skills are applicable to modeling markets the way I think markets probably are being modeled right now. So let's go with this article here. So maybe this can relate to your life a little bit. So if you have a big concert, right? Where do you put your speakers? How do you set up your all the sound system? Okay, so if you're a sound engineer in charge of a concert or something, this is what you'll have to do. So why wait? The where, how, and why of delay loudspeakers, providing intelligibility and clarity for the big shows by utilizing the proper application of time delay processing. Once a sound reinforcement system has to project to audiences located more than 100 to 150 feet or so from the stage, a bank or banks, so this is not a financial bank, probably, okay, they're just talking about a set of loudspeakers, time delayed relative to the main loudspeaker speakers, becomes an important tool. They're typically called delay loudspeakers, delay towers, delay stacks, and even just delays in the pro audio vernacular. These loudspeakers, often arrays clusters, are usually flown via crank towers or sometimes placed on scaffolding and are positioned beyond front of house. There can be a single array cluster flown centrally behind front of house, or if the audience area needing the extra reinforcement is very wide, there can be 2 or more arrays clusters separated by several dozen feet. The latest loudspeakers are typically deployed for several reasons. Sound pressure levels directly in front of the stage generated by the main loudspeakers can be kept at a more reasonable volume rather than blasting those located toward the front, while delivering additional needed volume to those located toward the rear. High frequencies are attenuated by the distance of air. So this is where physics comes in to play, okay? So I don't know if you know your high school physics, but there's a speed of sound, right? And what frequency is that sound wave at can also matter now. So that at 100 plus feet from the mains, there can be a noticeable loss of brightness. There may be obstacles between the mains and the audience, putting some of the listeners in an acoustic shadow. Well, I was talking about dead zones with cellular phones, right? So this is the equivalent of that happening when you're in a dead zone with your cell phone around in some crazy downtown with huge skyscrapers. That's exactly what's happening. So It's just as easy as sticking some loudspeakers halfway back into the coverage and linking to the left-right outputs of the console, right? Afraid not. While that might work mechanically, it won't provide the necessary intelligibility without the proper application of time delay processing. So this is where you get paid the big bucks to know this shit, I guess. All right. Okay, let me reload this so I can get the freaking picture they were gonna draw here. Come on, give me the damn picture. Come on. Oh my god. Well, if this thing doesn't load up soon. All right, here we are. All right. I guess that's you, the listener. I guess the main delay speaker, and then you got your delay, and somehow they computed 90 milliseconds. I wonder how they came up with that. As a result, sound emanating from the mains needs to travel 150 feet to reach the ears of those further listeners, while the sound emanating from delays only has to travel 50 feet to arrive at the same place. A little subtraction shows that there's a difference of 100 feet between the sound paths of the two loudspeaker banks. All right, 150 minus 50 is 100. All right, did that math good? Because sound travels at a rate of about 1,132 feet per second, while electrical signal travels at something like 1 billion feet per second. There will be close to a 90 millisecond delay between the two banks. The output of the mains will arrive 90 milliseconds later than the output from the delays. All right, that's enough. So now you kind of see where things are going here. If I know gold is going to do something, how do I figure out when oil is going to do something? What is the delay there? What is a relationship? And what is a relationship between bonds and whatever? How do I figure this out? Well, sadly, it's not as easy as physics, right? I don't know the speed of money. I don't know the speed of people being influenced by solar flares into their heads, and they think they're God and start like destroying the enemy of Israel. I don't know any of that. I'm sorry, that's too complex. That's why, engineering is actually quite easy. You just know some physics and you can figure this out. In other times, it can be quite hard because you actually have to make it into reality, right? This is kind of oversimplifying the problem. But in real life, not everything is easy because economics is not like physics, because it goes through human psychology and social environments and governments and other reasons, right? Like religion, philosophy, things that I can't quantify as a simple speed of sound, speed of light, speed of electrons. I can't do any of that. That's why it's freaking hard. And, we add more layers of complexity because there are people manipulating the markets, so they're bad actors. There's also now AI and trading bots. There's also, what else? News. So, right? People making noise, rumors. All that can't be taken into account as a simple equation. I wish it could. Then we all be millionaires and billionaires quite easy, but we can't. Okay? So, I'm going to read this article here. Fed waking up to inflation problem. This was written in around 2006 by McClellan. So Tom McClellan, and I played a presentation of his yesterday. So you can go watch the last presentation yesterday's stream. But this is where he came up with the 15-month concept. Okay. You have probably heard a lot more worrying about inflation reflected lately in the comments from Fed officials. Remember, this is 2006, about a year or two before the great financial crisis really hit. There is good reason for them to worry, and they should have been worried long before now. The point which has to be understood about gold and inflation is that gold is a leading indicator by about 14 months. For what inflation will do in the future. So that's your delay. Thus, if gold turns down now, it does not mean that inflation is over now. It means that inflation will begin to wane 14 months from now. We are pretty sure that few people inside the ivory halls of the Federal Reserve really understand this. The two charts on this page help to illustrate this point. The first one shows gold prices versus the annual growth rate in the CPI-U. I don't really know what the U means. I guess this was back in the time when the Federal Reserve had different ways of measuring inflation. I'm sure if you guys watch some conspiracy channel, they probably talk about the real inflation is actually this. Yes, the Federal Reserve has changed how they measured inflation many times already. Gold's price pattern has been shifted forward by 14 months on the chart to show how its leading indication reveals what lies ahead for inflation. The correlation is very good most of the time, and when the two don't work out quite right, there is usually somebody, Saddam, so that shows you how old this article is, OPEC, the Fed, etc., with his thumb on the scale. Once the temporary exogenous force, so that's a good word to learn for your vocabulary, exogenous. Okay, so this basically means a force that comes from outside. So it could be God, right? Maybe the second coming. The relationship gets back to working correctly once again. The core rate of inflation does not show the same acceleration that we are seeing lately in the headline numbers, because a lot of the price inflation we are seeing is directly attributable to the higher cost of petroleum products. Okay, so this is what they call the core CPI. Core CPI ignores food and energy. So the Federal Reserve, when they measure inflation, when they look at measures of inflation, they look at core inflation, meaning they ignore food and energy. But you guys can't ignore food and energy. Food and energy is the one that really bites in your wallet, okay? But because food and energy is a volatile component of inflation, the Federal Reserve ignores it. One reason they choose to ignore it is because when they decide how to change interest rates, they know that interest rates does not affect the economy until about 1 year after they change something. So when you look at Jerome Powell yesterday, he said, yes, we see energy going up. Yes, that probably will also affect food prices. Yes, we see that, but we can't change what we're doing, because if we change what we're doing to something that's happening now, it will take into effect next year, next March. So if by that time there is no more war with Iran in like a couple months, then the change that they would make in the inflation would not happen, because they raised the interest rates, and it might actually come at a bad moment next March. Maybe next March we'll have high unemployment, the economy is going down, and all of a sudden that interest rate hike from this year would slam into the economy next year, and that will be bad. And that's why they can't do it. That's a delay too. So gold can tell me with the future, but the Fed knows that whatever they do takes another year. So this article essentially says, like, why doesn't the Fed just look at gold instead of looking and waiting for a CPI number? Well, either the Fed is willfully ignorant of cycles, or maybe it's just the fact that they choose to do this because that allows other people that know cycles to make money and get out before the rest of the public gets out. So by the time CNBC says, holy shit, the whole sky is collapsing, you're too late. The stock market has already dropped 40%. So by that time, you have to buy the stocks, not sell the stocks. You sell the stocks when everything looks nice and peachy. You buy the stocks when everything looks like hell. So they probably know that people who know cycles know this, and the Fed won't do that, okay? The Fed won't tip their finger. But that's just my conspiracy side talking, so I don't know. Maybe they are that ignorant. I have no clue. Because cycles isn't an old concept at all. It's been talked about many times, as we heard from Tom McClellan yesterday. Okay, so petroleum products, right? So that stuff is not part of the core rate. Higher gas and plastic prices have not yet flowed through into the prices for other things, but that's coming. Truckers, ships, and airlines that haul stuff cannot keep operating at a loss for very long, and higher costs eventually have to get passed along. To get a better understanding of just what this predictive ability of gold is all about, let's dig deeper into the numbers. The second chart shows the same time offset relationship, but in this case, we have portrayed the forward offset gold price with the inflation rate on a XY scatter diagram. So this is where you're going to get your statistical numbers here. All right, so let's do a linear regression. If their relationship were perfect, then all of the dots would line up on a straight line, and the R squared would be 1. As you can see, it is not a perfect relationship, but it is still arguably a linear one, with a linear regression line added to the chart to help us visualize it. A linear regression line is a mathematical way of drawing a line through the data such that if you added up the distance of all the dots away from the line, that distance would be minimal for the linear regression line as opposed to any other line you might like to draw through the data. So that's stats 101. I mean, that's probably like stats high school level. I think you should learn that in high school, but I don't know nowadays. Maybe people don't in high school. But all right. You can just open a Word doc and can do this. Come on. So you got your plots here. You got your data here. And you can see it kind of follows the line, right? Yeah. So I guess you can say it's 14 months. All right. Except for some outliers around here and there. Okay. For the lower values of gold prices and inflation, it feels as though the linear regression line might be skewed too high. This is due in part to the mathematical effect from upper right values in the chart, which are well above the line. Those dots stem from the high inflation seen during the early 1980s. There are also some dots above the linear regression line at lower values which you cannot see because they are being masked on the chart by the other dots. You can't see them due to the limitations of the graphics, but they still count towards the math. It might be that the real relationship is not actually linear, but rather some mathematical version of curvilinear, parabolic, hyperbolic, with that curvature only becoming noticeable at the sort of upper extreme values for inflation that we hope never to have to live through again. So, are we going to live through some weird times where this linear relationship doesn't work anymore? If that's the case, then trading gold and silver isn't going to be easy. As well as oil and wheat and soybeans. If I'm just going to go off of 14 months, 15 months, 20 months, that's not going to work anymore. Huh? Shit. Well, maybe some of you smart cats out there can figure that out and make a lot of money, but I'm not going to do it. I think I made enough money. I'm already retired, and I'm just going to chill and watch the show, right, from a backseat. Let's assume for the moment that it is a linear relationship, or at least close enough to being linear at the lower levels. Let's also assume that this linear regression line is the precise and proper median line for the sample population of values in our data. The implication is that if you know today's gold price, then you can reliably forecast inflation rate for 14 months from now. It does not work out quite that perfectly in real life, but it does give us a rough target band of what to shoot for. Thus, a $470 an ounce gold. Now you can tell how old this article is written, right? $470. Now should equate to just above a 6% inflation rate in December 2006, plus or minus some amount of tolerance. for the imprecision of measuring inflation and for gold's inability to perfectly model the future. Even if the regression line is wrong and the actual inflation we see turns out to be only 4.5 to 5%, that would still be a problematic development for investors counting on the current 4.5% yield on 10-year T-notes. Now, do you think we got to that level of inflation just before the great financial crisis? I don't think so. Well, maybe the great financial crisis and the inflation caused by everybody running into houses and buying up a lot of real estate, causing the increase in housing costs and rental, crashed for a reason, because they saw that, hold up here, if we let this thing keep bubbling up, it's going to create so much inflation that it will spiral out of control. So we might as well pop that bubble sooner rather than later. The Chinese did this. So they had a housing bubble and they popped it manually. They were upfront and open about popping their bubble though. But I don't know if the American public likes to hear the fact that they engineered the 2007-2008 crash. So again, that's another side note, conspiracy-minded thinking I'm doing right now. But right, why does this gold inflation relationship work? There are a couple reasons. First, gold price is sensitive to the dollar's value. If the dollar loses value versus other currencies, that drives up the cost of goods and services if purchased in dollars. And that shows up as price inflation on the CPI. Second, if too much money gets created by the Fed keeping interest rates too low to stimulate economic recovery, then all of that extra money sloshing around in the economy has to go somewhere, and much of it goes into gold. Eventually, that excess money works its way through the economy into real stuff and leads to pricing pressure with more money chasing the same or fewer amounts of goods and services. But there is a lag in how that flow takes place. The lag is delay, and in how much such pricing pressures can finally be noticed in consumer prices. Pricing decision makers don't want to raise prices too early and risk losing sales volume. So they hold off until they see that they can get away with it, or until they have to do it to keep from going broke from the pressure of their own purchases being made at higher prices. This explains in part why gold prices lead oil prices by 11 months instead of 14 months like the CPI. So McClellan changed that to 19.8. So you can see this is a moving target. So he's done this before, and he said oil will follow gold in 11 months. Now it's 19.8. So if we go back up here, then this system is probably not linear. So if you have a non-linear dynamic system, which is what like trying to trade the economy would be like, this is a hard engineering problem. Okay, because most engineering problems, people try to make it linear because then it'll be simplified. Okay, even airplane, something as complex as an airplane has to be turned into a linear problem. All right, because if we want to design something in a simple fashion so that it's robust, you turn it into a linear problem and hope to God that the airplane doesn't do something funny that the engineers didn't take into account. So you're going to assume that the pilot will fly the airplane in a way that doesn't go into an area of the mathematics that makes it nonlinear. And we could be at a point where things get so messed up in the economy and the Fed's ability to control the economy that it'll just not be a straight line, some ziggly, zaggly, S-curve, linear curve, parabola, this, that, and then all bets are off. I can't even trade this shit anymore. And essentially you have to say like, well, we're screwed. Sorry, guys, your 401k is probably busted. Okay, because if they can't make that nice S&P 500 go in a straight line, I don't know what to say. So a lot of the American wealth and retirement and also the global economy, because we have to remember that foreigners own about 30% of U.S. stocks and 20% of U.S. bonds and dollars. So this thing goes out of whack, then good luck to everyone. Okay. Okay, so it takes a while for oil price changes to show up in other goods prices. Okay. So now that you know all of this, pretend for the moment that you wake up one morning and discover that you are Alan Greenspan or even his replacement in February, and you want to achieve a stable money supply and inflation situation. You would realize that the 1% Fed's fund target that you had imposed was a bit too stimulative to the money supply, and that it has brought about this $470 an ounce price in gold. You have already raised the target Fed fund rate all the way up to 3.75%. And now some of your fellow FOMC members are trying to convince you that rates are high enough to have done the job of quelling inflation. Are they right? Probably not, since the rates have not been raised high enough to push gold prices back down. If we want to have inflation down around 2%, like many of us got used to seeing just a short time ago, then gold has to be pushed down to somewhere below $340 an ounce. That's going to take a lot more pushing than a 3.75% Fed's fund rate is going to do. Does that mean that the Fed is not going to stop? Well, that's a different question. If you get 12 guys together who are professional bureaucrats and who are trained in the standard understanding of economics and inflation, there's no telling what they might collectively decide to do while sitting inside of a conference room in the Mariner Eccles building. What they decide to do is often different from what they should do. They might really think that they are done raising rates, and they might act accordingly at some of the upcoming FOMC meetings. But gold says that they have not yet licked inflation, and the risk here is that the dog might run away faster than the Fed can chase it to get a leash back on. So I'm going to stop here, okay? Because that sounds very familiar to you, I'm betting. This was written in 2006. We are 20 years later. And doesn't all this sound quite familiar to what the Federal Reserve has to do now? If oil is going to be as high as it's going to be and stay at an average of $80 a barrel, maybe even creep up to 90 or 100 from time to time, then yeah, good luck. Gold is coming back up sometime down the line next year, and the Fed will be too late. Where'd you learn all this? Did you pass the Series 7? I don't... Series 7? What is that? Is that some test I have to do? I don't know. I don't know any tests. Is there something? I don't think. I don't think I ever took any finance tests, man. So John Galt actually passed the CFA, I think it's called. So you can talk to him. He worked at a bank or some shit or something like that. I don't know. Let's see, CFA test. Yeah, he took the CFA. I don't know what the Series 7 sounds like. Some other finance test. No, I didn't take anything. I don't have time for that shit, man. I'm just an engineer, bro, or at least I used to be. And you know, when I've always been a guy that likes to learn things. Anything. So in school, I did 2 other minors. So not only electrical engineering, I did history and anthropology. I love history. Anthropology, I specialize in linguistics anthropology, so learning how language affects people in society and whatever, or human behavior, I guess, a little bit. So if you know the Sapir-Whorf or whatever they call that, Sapir-Whorf hypothesis, that's a famous one that people talk about. Does language affect the person's mind, or the mind affect the creation of language? And yeah, from there I just like learning anyhow. So I got my PhD and all that shit in liquid. But like, yeah, I took a lot of courses anyway outside of that. So I just like learning. No, so I just learned it on my own, man. I just did it. I just went as I go, as I went as I go, whatever you want to say. That's it. And if you read enough of stuff, you'll learn everything. There's so many videos on YouTube or whatever. YouTube, that's what YouTube's for, education too. It's not just looking at the Boyd Thorpes or anything. That's what I use YouTube for. And you read a lot of articles, people's articles, and you figure shit out. You go like, well, does this work? Does that work? If it doesn't work, I'll ignore it. If it works, I'll keep it. So that's what you got to do. You have to do your own research, man. And a lot of people probably don't have the information to do that. You have to like learning. Learning how to learn is something that probably is the most important thing you'll ever have to figure out. And I'm guessing not many people can do that. Okay. So let's see what Powell said. Powell says this. Says he will remain as Fed chair until successor is confirmed. What does that mean? So, Mr. Powell said that even if his successor wins confirmation, he would not leave the board. He's not leaving. This motherfucker ain't leaving entirely until the Trump administration concluded a criminal investigation into his handling of renovations at the Fed's headquarters. Mr. Powell has previously denounced that inquiry as politically motivated. Technically, Mr. Powell's term as Fed chair ends on May 15th, but he can continue to serve until a new leader is formally in place. He can also stay on as a governor until 2028. So yeah, he can just stay there and be a thorn. He'll keep voting for higher interest rates and keep pissing off Trump or something. Why not? You could sit in the chair until 2028, technically. It's never been done before, but yeah, he could do that. Why not? F you to Trump, right? He's been trying to kick you out for how many times now? So, yeah, here's a CNBC version of the article. Yeah, Powell said he won't leave the board of governors position, which technically extends until early 2028. So pretty much most of Trump's tenure, he could still be there and be annoying. Even though Walsh would be the new chairman, he could still be there. Behind the scenes, fucking shit up. Oh, did the markets like that? I don't know. It probably did not like that. So that's why it went all fucked up yesterday. And then Micron earnings and all that, it just got worse and worse. What the fuck? So let's listen to what the pros
for you. Well, I think two things, John. One, there was a sort of more humble aspect of what Jay Powell was saying when it came to tariff price inflation. He was conceding that it wasn't doing what they thought it would do, lasting longer than they had anticipated. And now layer on top of that inflation that will come into the energy markets and perhaps others because of oil. And so he was less saying the idea that, well, we're prepared to go either way depending on what happens with the economy, as he was saying, we've been fooled and we're not going to put ourselves in that position. We're going to sit back and wait so that we don't react wrong because we've been wrong. About that so far. He Presidential Counsel's Office memorandum a not big legal fight down the road if they don't get Kevin Warsh in there by May 15th.
Yeah, controversy.
Well, he's trying to provide consistency, I suppose, by saying not much is going to change until my successor gets here. Way to push back on the pressure he's been getting, we don't really know. But at this point, you have to think the White House is going to disagree with that interpretation of who's chairman pro tem. Now, it's important to realize, too, that the chairman pro tem of the Board of Governors is largely irrelevant for a short period of time until they get Kevin Warsh confirmed. It's staying as chair of the Open Market Committee that would really bother the president, because as Torsten was just saying, leaves somebody who's more hawkish, more likely to vote for a hold on the board.
Mike McKee with the latest. Thank you, sir. Appreciate it. Great job as always. Mike there at the Federal Reserve down in Washington, D.C. Torsten, can you answer that question? We've touched on it briefly with you. Just expand on it. Does it provide consistency or introduce controversy?
Well, it would definitely be a lot cleaner if you have a Fed chair and then that Fed chair walks out and a new Fed chair sits down and then we continue with a new Fed chair.
That's how it usually works.
That's how it normally is. That's how we want a Greenspan, I've got Yellen, under Bernanke. But now that you suddenly have this issue that the existing Fed chair, either he may stay on the committee, which is also a huge issue, or we may not have Kevin Warsh in the seat. And as Mike was just saying, that will raise all these other legal issues around, well, is this something that you can do or not do? And that, of course, begins to just raise a lot more uncertainty about Fed independence and what is the institution making of decisions.
Do you think that it's leading market participants to not take into account some of the forward guidance or some of the discussions on the Fed, that there is less credibility as a result of some of the increasing political rhetoric around this institution?
Well, I think that we are moving towards a Fed where the focus will be at the extreme on dissents. Today we had 11 versus 1. That was very clear. But going forward, we are likely going to have, especially over the next several quarters, as other FOMC members might be leaving, we will have much more scrutiny of what are the existing members saying, what's the differences in speeches, what's the differences in footnotes between someone who was dovish, someone who was hawkish. We are entering an era of Fed watching where things are getting much more complicated because it has this political dimension of why is this person saying this? Is this person staying on the committee for political reasons? It just opens up a whole different dimension to Fed watching than what we've been used to for a long time.
Fed parlor game, but you're expert at this. On a global basis, the central banker to the world, to borrow from Bill Rhodes, Jerome Powell has to look at the varying energy intensities with Brent crude at nearly 110 a gallon. We've gone 106, 109 here right now off headlines on the Bloomberg. When you look at the way EM is crushed by these prices, food, energy, and the rest that you're expert at, Torsten, does the dialogue just shift from the conventional parlor game?
Well, there's been discussion here about the swap lines. There's been discussion about, in the broader context of things, what is the Fed's mandate, and it's the Fed's man who is supposed to take care of the global economy. And it's very clear that the trend of travel here seems to be that we're moving towards that the Fed should really be caring mainly about the U.S. economic outlook.
Is it expressive currency? Is that what we're not seeing in the Q2?
Well, given that foreigners own roughly around 20% of treasuries, 20% of credit, and roughly a third, of course, also of equities, we still have a situation where foreigners do play a very important role in U.S. financial markets. So that key issue of what is the goal of the Fed becomes very, very important.
Just struck by how historic this is. The last person to stay on at the Federal Reserve as Fed chair after his term was Mariner Eccles. This was in 1948 when his term was up, and he stayed on because he was concerned about the post-Bretton Woods order and consistency. That was the last time this happened, and I just am struck by the historical parallel at a time when we are questioning geopolitical alliances, when we're questioning how exactly some of these monetary policies are going to work in an inflationary world at a time of increased government debt. It is interesting that we're dealing with the same discussions, and I think it can't be forgotten, these sort of echoes that we feel from 1948.
I think it's easy to introduce one's opinion into this situation, so I'll just allow the market to guide us. Clearly the chairman is concerned about a threat to independence. Is he right to be? Look at inflation expectations right now. Market-based inflation expectations have remained really well anchored throughout all of this. So whether you're concerned about the chairman's attack on the institution or not, let's just focus on the markets. Markets have decided it's not a credible threat. So does the chairman actually have a role here that he needs to play? Is this a card he needs to hold? I don't really understand that. I'm struggling with that. That's something I'm wrestling with. My opinion doesn't really matter. The market's telling me there isn't a concern with central bank independence. The market is telling me there isn't a concern with inflation expectations, and the data is telling me that the rest of the world's not worried either, because when I look at foreign ownership of US assets, they're rock solid, and for treasuries, I think they're at all-time highs at the last data point I saw, Torsten. So is there a problem here that the chairman even needs to address?
Well, that's why the key question becomes, what does confidence mean? Is it confidence by Jay Powell? Is it confidence by foreigners? Is it confidence by markets? It does become a very important debate. That's why this discussion around who will be the next Fed chair. Now we know it's Kevin Warsh. There was around that time also a lot of discussion around it could have been someone else who might not have been perceived as credible as Kevin is. So for that reason, I completely agree. Who is the judge ultimately of what Fed credibility is, and where do we look and where does the market look for evidence whether Fed credibility is being threatened?
And look how many establishment figures came out when Kevin Warsh was nominated by the president. How many establishment figures, and forgive me if you're insulted by being establishment, Gita Gopinath, formerly of the IMF, I don't think it gets more establishment than that, endorsing Kevin Warsh and saying he'd make a great Fed chair. Mark Carney of Canada, the former governor of the Bank of England and now Prime Minister, endorsing Kevin Warsh as a future Fed chair. What exactly is the chairman defending here when it is standard protocol to leave once your term is up?
Well, I think that that's a fair question. And ultimately, my personal opinion doesn't matter. And frankly, I don't know what my personal opinion is. I just think that there is a sense right now in markets, to the point that Fed Chair Jay Powell made, that even on Congress's level, they have confidence. And they would like to see Fed independence continue. And that's you see in Tom Tillis's move. So what would make him stay on? I guess that's one of the questions. What would change his mind to actually remain on as governor past his term as Fed chair if Kevin Warsh were in the seat that would make him feel like he needed to uphold this Fed independence?
Jeff Rosenberg of BlackRock joins us now for more. Jeff, I imagine you want to avoid this topic altogether. So I'll ask you about the
Hello
substance
there,
of the news
ladies
conference, the
and
shock from the
gentlemen.
middle.
Welcome to a random schizo stream. Short, because I woke up today and I just want to yell how much I hate Brit bongs. I hate the British. I hate the Brit bongs.
All right. Yeah, I love this. I got my new sound clip. Anytime any British person shows up on the show, I'm gonna play that. So anyway, I'm tired of that shit. Anyway, forget what BlackRock wants to say. I don't care. I don't care about your lies. All right. Anyhow, that's good enough there. So people don't know what the Fed's doing. Who the fuck knows? How am I supposed to know? No clue. No clue, guys. What am I supposed to do? Okay. Let's see here. We got 1 hour, 41 minutes. All right. Okay, let me see. So we got to round it out for 2 hours. All right, got to round it out for 2 hours. Let's see if we got time. So I'm going to go back to the charts a little bit, and I'm going to play 2 more little videos. Okay. I think I covered most of what I needed to talk about. I might have to save that article for later. Okay, let's see how much I can get through this. Maybe I can go over 2 hours. I don't know. Get inside here. Let's see. Okay, we'll see, guys. So let me pull this crap back up. Load it up. All right. Fuck. Sucking all my memory. Okay, before we do, let's read something here. Now, if you noticed, gold and silver was dropping even before Paul was opening his mouth. Why did that happen? Well, the U.S. producer prices rose 0.7% month over month, above the 0.5% in January and higher than the forecast of 0.3. So this is what the February numbers gave us. 0.7% increase in the producer prices. So that's going to go down into your pocket eventually. It is the biggest increase in producer prices in 7 months, with goods prices soaring 1.1%. And this was before the oil crap happened. That's not good. So gold and silver looked at this and said, hell nah, and it dropped. So that explains why after that Powell opened his mouth, and then global oil, Brent crude, went up again the next night. And that's why you had 2 multiple overnights of terrible gold and silver performance. Okay. What's going to happen over the weekend for gold and silver? I wish I knew. If I knew that shit, I wouldn't even be talking to you guys, because if I gave you any inside information, I'd probably get killed, man. All right. So, with goods prices soaring 1.1%, the most since August 2023, led by a 48.9% jump in prices for fresh and dry vegetables. Bruh. The oil hasn't even hit these prices yet. Transportation, diesel costs goes up. And fertilizer costs are going up because you can't get your nitrates without your natural gas from Qatar, apparently. So then what's going to happen? More hurricanes because of sunspots? I don't know. But if you add it all together, it looks like we're going to have a bad 2027 for vegetables, at least. The indices for diesel fuel, chicken eggs, gasoline, jet fuel, and tobacco products also increased. And reminder, this is still February. This data ain't taking into account all the Iran stuff happening now. Be afraid about what this is going to look like down the line. Conversely, prices for jewelry and jewelry products fell 4%. Well, yes, of course, silver and gold went tanking, so that helps. Decreases were also seen in the cost for home heating oil and for soft drinks. Well, that'd probably be okay. We still have U.S. natural gas, so probably no problem there, but I don't know. That probably will offset the heating oil price increases if you use more natural gas. Okay, meanwhile, prices for services rose 0.5% and the least in 3 months, with prices for traveler accommodation services, i.e. hotel, is rising 5.7% and making the largest contribution. The core PPI increased 0.5% after a 0.8% rise in January, but above forecast of 0.3%. Okay, so that's the core. So we take out the food and energy. So yeah, it doesn't look that bad when you don't take into account vegetables. On an annual basis, headline producer inflation jumped to 3.4%, the highest in the year, compared to 2.9% in January, and forecast it would remain at 2.9%. Core producer inflation also jumped to 3.9%. Okay, so let's get year-over-year 3.9. That doesn't look good. 3.9%. Holy crap, bro. So let's see. Can I go back? So, oh boy, last time it was this high was January 2025 last year. So we're gonna go back to the COVID days when it's going up to 10% and shit. Oh, great. Good luck. Core producer prices, which excludes food and energy, so that's the core. Get rid of that food and energy. Pesky. Rose by 0.5% from the previous month in February 2026, slowing from a 0.8% advance in January, but surpassing market forecasts of a 0.3% rise. Final demand goods price, excluding food and energy, went up 0.3%, down from 0.7% in January, and services prices increased 0.5%, following a 0.8% gain on a yearly basis. Yeah, we already read that. Okay, good. All right, that's enough. So that's pretty much explains to you why gold took a crap. Okay, gold took a crap. So let me read to you this. If there's higher inflation and bond interest rates go up, because basically the bond market is saying, well, there's going to be higher inflation. Well, looks like we're going to have to get rid of our bonds. So when bond yields go up, prices of the bonds go down. Why does that happen? Okay, let me try to explain it to you for the 100th time, I guess. It's the fact that people don't want bonds that are being sold now because future bonds are going to be at a higher interest rate. Why would I buy a bond now when I know that next year the bond will pay at a higher interest rate? So the demand for the bonds today is lower than the bonds in the future, right? So that's why you'll have this weird relationship, inverse relationship, where prices of bonds now is going down because they're waiting for the higher price interest rate bonds later. That's the theory. Right now, nobody is predicting the interest rates are going to go back up. They are, however, predicting that interest rates are going to stay higher for longer. So that means that people are willing to hold on to their bonds, at least, and the demand of bonds will stay steady for longer. Gold only goes up in price when they feel like bonds are not going to be in hot commodity later on in the future. Okay, so there is a relationship there. Higher interest rates typically put downward pressure on precious metals. This is what the AI gave me, this Gemini, whatever. Okay, so it's pretty much correct. So I'm not gonna waste my time and make my own explanation for you. So they put a downward pressure, the highest interest rates, on precious metals like gold and silver by increasing the opportunity cost of holding non-yielding assets. What does that mean? That means me holding on to a piece of metal that doesn't pay me interest. If I own a 30-year bond paying around like 4% from the government, from the federal government, I get 4%, right, every year. That's my return for the year is 4%. Okay. So I get a nice coupon every month or every quarter that pays me and adds up to 4% return after the year. Gold and silver doesn't do that. Gold and silver is a piece of metal. It's a piece of metal. It's not a government. It doesn't pay me in rent. I actually have to pay it rent, probably. I have to pay someone to hold my gold and silver, probably. So if I'm a big buyer of gold and silver, I have to pay for security guards. I got to pay for a vault. I got to pay for auditors so that I make sure nobody's stealing from me. So it actually is taking away money from me to store that hunk of rock. So that's why this happens. Okay. So if bonds have higher yield, guess what? It's competing with gold and silver a lot more. Because gold and silver do not pay any interest or dividends, high interest rate environments make them less appealing compared to bonds and cash equivalents. That's what I told you right there. Okay. Rising rates also strengthen the US dollar, making metals more expensive for foreign buyers and can reduce industrial demand for silver. That's another reason. Okay. So rising interest rates often boost the value of the US dollar because a lot of people are converting their money into dollars to get the bonds in the US Treasury. So let's say I have exhausted all my yen. Let's say I'm in Japan. I used up all my yen to convert to dollars to buy US bonds. Now I'm thinking maybe I should sell some of my gold and silver to convert it to dollars to buy more bonds because I exhausted my supply of yen, right? Or I could sell a house too. I could just sell a Japanese house because I'm just love those bonds so damn much for some reason. And I don't trust the Japanese real estate market, or like there could be many reasons. So now you see, like, it's not a one-way relationship. There's multiple access points going in and out of money, going between currencies, going between bonds, competing with stocks, gold, silver, Bitcoin, everything. Everything competes with everything else. So it's always a competition of what gives you the most bang for your capital. Okay. So hopefully that it makes sense to you. All right. Okay. What's the other things I want to talk about these charts here? So this is the Cohen. I think this is the Cohen indicator. This BINYHLC. It's Larry Cohen, I think. So I have two of these lines right here. So the bottom two panes. See that? You see the green going down here and the orange. So the orange is for the NASDAQ. The green is for the New York Stock Exchange. When it drops below about 50% here, so it's going below 50% right now, this either could be a time to buy the dip, or it could be the time to be worried that this is the beginning of a bigger dip. So you can see the last time this happened was around February 2025 at the end of it. And you saw that this was a prelude to the bigger dip in March and April. So is that what's happening now? Or are we just having a minor little hiccup, just like in November, and we'll just go back up again? Wait and see for next week. That's what we got to see for next week. Now, the other reason I didn't do any of the presentations last year after April was because of this. You see this signal? This is the, what do they call it? The Zweig breath thrust signal. The Zweig breath thrust I talked about in my first show this year, and I explained to you why this is important. It pretty much said that, like, when this breath thrust hits, the S&P 500 will go up around an average of 25% over the next year after this signal. So that means I don't need to say shit. You could buy pretty much anything in the stock market and it'll go up. Anything. Now the question would be, like, which one would be the one that will go up the most? I can't do that for you because I don't have a crystal ball. I picked semiconductors. I picked pretty much correctly. The only thing that could beat semiconductors over this past year would be like maybe some gold and silver, depending on when you got into gold and silver though. But overall, semiconductors had the best run between April to about, I think, late January, early February, thanks to memory, thanks to Micron, thanks to SanDisk, all those companies. So it extended it out from November, December into January, February, thanks to those companies. Not thanks to NVIDIA, not thanks to Intel, not thanks to AMD, none of those. So those things kept it going. The other thing too was the optical manufacturers. So optical fiber and all that. Okay. Now, let's look at this signal. This is my own signal. So this one, I try to predict crashes here. Sometimes it works, sometimes it doesn't work. But I'll still use it because I think it's an interesting one that I made up. It uses the McClellan summation index. I use the correlation between the summation index and the S&P 500. So the summation index of the McClellan summation index of the NYSE. And every time it's an inverted correlation and then comes back up positive, it's a yellow light to me. And then when the actual summation index goes below 0 or some arbitrary level that I pick, usually if it goes below this 200 and then it starts dropping into 0, I pretty much will assume that it will get through 0. So you could make this signal trigger earlier if you want, I guess. I don't think you need to. You can wait for it to get to 0. And yes, pretty much yesterday, it's gotten back to 0. We've gotten up. We had a false signal here in November. So again, November was the last chance for a big drop, and it didn't happen. This was pretty much due to NVIDIA earnings. You had a big pop on NVIDIA earnings, and then all of a sudden it just crashed for the whole day into the next day. And that took down the NASDAQ. But after that, somehow people bought the dip, recovered. But that was one crazy event. One company pretty much took down the whole S&P 500 and NASDAQ in such a way that it was literally about to say, yo, we are about to crash bad. Now we're back in this situation again because of the oil. So is this one going to last long? Well, I'll let you decide. All right, I'll let you decide because it looks like it might be. Okay. So yeah, next week, guys. Next week, we'll see how it happens. Tomorrow we'll have Iranian New Year's, Nowruz. It will be a spring equinox. Maybe there'll be some kind of crazy event happening in Iran. I'm sure everybody knows that date is important. It's a big psychological date. If they do some big operation in the New Year's from either side, then yeah, it might be something on the weekend, guys. And that might be the thing to do it, to push this market over the edge, and you'll finally get the dip to buy whatever you wanted to buy. All right, so that's why I have to look at the boomer portfolio and decide for you what's going on. All right, okay, so yeah, that's it. I think for that, let me review everything. So we're about 2 hours in. Good. So let me go over again the markets. Let's look at the SPY. Let's look at everything else. So we're looking at this volume weighted price here. And see that? We bounced around this range and then it just went down, and now we just retested the bottom of this range. And now we're just dangling around here. If we look at this volume price point here, this red point of control that was pretty much dominant from the May to December timeframe in 2025, essentially. This was where we were headed towards. into and stayed about. We're dangling below that. So once we get below 652, I guess next week, that'll be the signal to say, yeah, you fucked. You fucked. The S&P is gonna finally go down. Or it could be a fake out. It could just dangle down there and then bounce right back up. I don't know. Shit. It depends, right? Anything could happen. Somebody might be screaming in pain and they'll stop it from dropping. So let's look at the NASDAQ. You see here I put like the Wyckoff thing here, so you can kind of look at it like that. So you could say, okay, this is like, looks somewhere around here, right? Maybe it's like, oh, okay, we got this. We got this here. We got the automatic reaction. Okay, we got the bottom here. We got the up thrust, I guess, kind of. We got the test, the UTAD, and then now we're just dangling here, which is basically the LPSY, the last point of supply, something like that. But this is pretty extended, you know. This has been dangling about since February, even before all that Iran stuff happened. So what are we waiting for? You got all the earnings. You know Iran's happening. So do you want to buy this and go back up, or you just want to puke? Because it looks like you want to puke. Because I don't know, man. Come on, it looks pretty much like you want to puke, but you've been kind of teasing people that you're not gonna puke. It makes me a lot more worried, because then the longer you stretch this out, the deeper I'm guessing you're gonna go, right? So the other thing too is that semiconductors has been the one saving things. This has been the hero here. You can pretty much see it's like this right now or something, and it's pretty much a hero. So let me look at this for you. Let me pull this up. Okay. All right, hold on. Get myself, make sure I got the batteries. All right. So here with this, get this. Okay. So this is what happened today. So after Micron, you had this nice drop into this range, pretty perfect, you know. So I was shorting just before Powell opened his mouth, because like we were edging right here. We keep doing this. We keep like, it keeps trying to get below into this yellow area. It keeps edging, and I was like, okay, I had enough of this. I'm gonna short here, right? Just before Powell talked, I went SOXS, went down. I said like, I'll just keep it, wait for Micron. Went down in the morning, and you could see, you can pretty much see like within 10 minutes, they bought it. So they pretty much kept the S&P from collapsing. They were like, whoop, within 1 hour, it was just like, ram, right there, slammed right into this dash line. And then for the last moment, I guess there was something about Saudi Arabia is going to pump more oil through its pipeline, avoiding the Strait of Hormuz. Maybe it was Basent rumors saying like, hey, you know what, we're going to not sanction Iranian oil that's already out in the open ocean, the open Indian Ocean. If it's already out in the open Indian Ocean, we'll let countries buy the Iranian oil out there. Okay. It was something. I don't know. It could have been anything. But in the end, all we have to do is make sure that the S&P 500 gets to a certain price level before Friday, right? So we're going into Friday. We want to make sure it doesn't fall away too badly. We have to make sure it gets max pain. That's why I was talking to you last time. So, and you know, look at it. It tagged the bottom of that yellow zone and fell back. It's crazy, man. These things always get magnetized towards this bottom of this yellow, but it doesn't want to get into the yellow. I don't know why. Not really sure. You know, why wouldn't it try to get in? Because I guess they're running out of things to push up the market right now. They're pretty much running out of things to push up the market. So let's see what happened today with some of these tickers. You see this? You see what's this? Let's look what they're doing. They got tired of pumping Micron into earnings. They got tired of pumping SanDisk, Western Digital, Seagate. So the 4 memory, hard disk drives, all those stocks. And all of a sudden, they started pumping the optical stocks again. So opto electronics, Lumentum, Ciena, Coherent, AOI. They pumped those today for some reason. I don't know what the news was, but hell, that helped it out. Whatever it takes, man, to keep the S&P 500 from going down. So that's pretty much it. I don't know what's going to happen next week, guys, but you better be careful for anything. I'm not going to say one way or another what I would do. You're taking a big gamble if you want to bet big on gold and silver over the weekend. It could pay off handsomely if you pick the right direction, I guess. If you're using options, I'm sure you probably can figure out a way to make the risk, the loss, a set amount. That if you want to do that, go ahead. Do whatever you want. With gold miners, I think it's probably the most lucrative because the gold miners will move in an exaggerated fashion and then you can make a ton of money if you do it right. But again, that's tactics. I can't tell you what your tactics should be. Okay, that's it, guys. That's it. So tomorrow, Napstar will have a stream. Okay, Napstar will have a stream tomorrow. So let me give you the link. It'll be about 10 p.m. Eastern, I think, at night. So he's gonna do a late night stream for you guys on the Eastern Coast. West Coast guys like me, it'll be 7. I don't know. Last stream was interesting, but we'll see what this stream will have. He titled it "No Justice, No Peace." Not sure what that's about. No justice, no peace. Okay. So that's the link. Okay. But you can just go to his channel at Anita Bong Hit with the banner that's scrolling across there. Bong Hit. So I think this is right. Yeah. So here. That's the @ This is the @ Anita Bong Hit. All right. And I had an article to read, but I'll read to you tomorrow, I think. All right. I'll read to you guys tomorrow. Okay. It's this. How bull and bear markets differ in day and night trading patterns. You know, when you have a bull market, most of the gains happen overnight and you have a gap up. So this is what it looks like when you have a bull. Most of the gains occur overnight, not during the day. And in bear markets, you know, most of the changes, the downward events happen during the day rather than at night. So if we are entering a bear market, you probably should stick to day trading during the day. And then when we're entering a bull market, you use futures and trade overnight, I guess, if you just want a quick buck. But usually you don't need to do that. In a bull market, all you have to do is buy and hold, just like we did in April up until October, essentially, November. And if you were in semiconductors, all the way into late January, early February. You don't need to trade. You just buy and hold and it will just go up because every time you have a gap up, it'll just hold it. And it's easy to make money just by sleeping overnight and you wake up in the morning and you're like, oh, it went up again. Oh, look, wake up again. It went up again. So in a bull market, that's what happens. In a bear market, it might go down overnight, but then it'll go down even more during the day. So that will give you a lot of trading opportunities. If we go in a bear market, you can do quick trades up and down in a bear market. If you pick the right moment to do it, though. Okay, so that's something we'll talk about maybe tomorrow if I feel like streaming tomorrow, or we'll do it over the weekend sometime, because we're gonna have to discuss a lot more important things. I also will do a little reading, okay, from the Honorable Elijah Muhammad, The Tricknology of the Enemy. I think this will be good for you guys to learn about tricknology. Yeah, we're gonna cover some tricknology, okay? So that'll be interesting to learn as well. And the thing about it is that, like, I want to emphasize this point. Like, don't get too deep into conspiracies, because then you give your agency to other people. If you really believe that the market is rigged, this is one of those things that will happen in tricknology. The powers that be want you to think it's rigged so that you don't even try to understand what the market is. Don't get suckered in and say, like, oh my God, gold and silver is being manipulated right now, they should be going up. No. Gold and silver definitely gets manipulated, but I have to tell you, there are major factors why gold and silver has to be going down, and hopefully Samantha LeDuc's video and my explanations have given you enough food for thought as to why things are happening the way they are. Okay? If you give your agency to someone else, you really are doing yourself a disservice just by knowing certain things, like how long it takes to go between inflation and gold, oil prices and gold, shows you that there's a delay in the system. Okay? People buy early for a reason, and they also will sell later for a reason, or sell early for a reason, or whatever the reason might be. But there are lags, delays between certain events. So when we do eventually get into a bear market, usually the bottom happens before the true bottom of the economy hits. So there's a difference between the cycle of the economy and the cycle of the stock market. Just like now, there's a top. When there's a top in the stock market, there are some sectors that lead. Which are those sectors? Oil, natural gas, energy leads at the top of a market. So we are at a top of a market if oil and energy is now the leading performer of the S&P 500. So you'll see oil leading, right? You'll see materials leading. You saw gold and silver, copper lead into the end of last year. All these lead up together. Then you'll start seeing staples, healthcare stocks leading. So we're going to have to look at healthcare and some staple stocks. We're going to have to see if, like, Dollar Tree is actually a good place to be in. Dollar Tree and Dollar General and Walmart. And then so some healthcare stocks essentially are some big pharmaceutical stocks, I guess. I don't know. We'll come to there, and utility stocks. We'll have to come to that point sometime later. But right now the leader is energy. So this is the beginning of the end. Once you start seeing materials lead up, like at the end of last year, and then now energy leading this year, we are at the beginning of the end. We are at the top of the market. So now we have to see more signs to see when we're going to roll over. Okay, so that's why the Buddha said, he took away the ignorance of the past, the ignorance of people praying to the gods. This is how they did it back then, right? They would pray to a god. Okay, like the Hindus would pray to the sun god every morning. So thank you for coming up and heating and warming my town this morning, coming up again. So the prehistory, right? The primitive man would trust a god to give them something, And anything that would happen to them is because of a god, right? That's how the Greeks also saw things, if you read the Iliad. So, no, you have to be in control of your own destiny. So with the knowledge that you learn, you should be able to do what I do and figure out the markets. That's exactly what it is. Why is a correction such a big surprise? The only really bad outcome would be to sell your silver gold. I did buy oil 2 weeks ago and it's up 49%. I don't know. I don't know if it's a big surprise. It wasn't a big surprise to me. I already told people that anyway, but you know, I played the video where the guy bought silver at 100. So, I don't know. I've already been telling people the oil shit. I don't know. Is it a surprise? I think it's a surprise to someone, and there's always a bigger fool. There's always a bigger fool out there. Otherwise, you couldn't dump your $110. But yes, you have to be in control of your own destiny and understand how the markets work if you want to play this. Otherwise, you're gonna have to believe in fate, right? Or you believe that your 401k mutual fund is managed correctly by someone. So that's about it. That's all I gotta say about that. Otherwise, you could do this. You could sing this mantra. So I guess every time we wake up in the morning, I could just stare at the sun and do this and go. Is this what I would say? Om Suryaya Nama, Om Bhaskara Vidmahe Mahajitukaryaha Dimahi Tano Surya Prakchodayat. I think the Matrix used this prayer in their songs, I think. I don't know. But anyhow, yeah. I think you shouldn't believe in anything. Okay? That is too far out there. All right, don't let there's definitely conspiracies, but don't let that take away your determinism. Okay, your free will. You have free will. All right, at this point. All right. Anyhow, okay, we discussed that good. So I'm gonna end with 2 of these videos, and I think this is pretty much in line with what I expect the future holds. This is part 1 and then part 2. Very short videos.
Quick analog, and if we are looking for the environments that are similar, I was going through my mental data bank. I was remembering that we were doing this in 2014-15. It was probably one of the most frustrating markets, like nothing was happening. Even now, there is more volatility than it was back then. But look at the resolution and look how it all starts and how it ends. Point number 1, we see quite a huge reaction. This was in October of 2014, and it was coinciding with some kind of epidemic or pandemic in Asia. Then looking at the current picture, and obviously this is after the up move, so context is the same. We see that increase in selling and buying at the same time. This is improvement by selling. This is improvement by selling. They just improve in different ways. One improves in the distance, one improves in time, duration. Then we have the rally that overcomes but starts to diminish the thrust from the previous thrust. So we see that. Then 3 to 4, again, improvement by selling. And then we finalize that move into some kind of climactic conclusion. In this case, it's stronger at 5, but then 6 is producing that volatility that has both depth and duration as well. So is going down, and then we cannot produce the next rally of significance that would be extending. But that rally going into the exhaustion by the demand from here and from here still has some legs, right? So look at the first leg of it. Pretty dynamic. Obviously in 2014-15 that was much stronger going into the higher high. Then has multiple reactions, almost like its own trading range. And then we go to point number 9. This is the highest point for the whole structure. Here, I think we ever slightly, this is NASDAQ, touch that. So what happens after? We have some kind of change of behavior to 10, change of behavior. And it's interesting that in this type of the environment, where first there was some kind of leadership, outperformance, and then such a deterioration by the demand, like disproportionate deterioration, right? We're gonna have the change of behavior that is not gonna be very distance oriented in terms of the extension and the result. We're gonna have more in line with the distribution of the leadership. So then this area right here is what we're going through right now. And the first leg up is the most aggressive, right? So demand comes in, the buyers are saying we're at the support, let me buy this. They are buying, and then no result or limited result.
All right, let's play part 2. Okay, that's where we're at right now, I guess.
Look into this bar right here. What an interesting bar. Oof. Where did we have it here? Oof. Like it feels the same. So one more bounce and then aggression. Like in 4 days, we are doing a lot of damage right here, going through multiple phase levels. How would that look with this type of hanging below the ice? We're going through different levels, right? So it could be even 2 levels, like going into this and or going just to this and then recovering. So if we're looking at the short-term bearish picture, I think it would be appropriate to have something like this. Let's flush everything out of the system, all of that liquidity, and then go first into the local trading range, and then possibly even into a larger structure. Look at how in 2015-16, we are actually coming back to the height of that structure. So imagine, if we go down like this, and then we start to consolidate locally, come back to this level, and then coming back. So very similar to what we've done, actually almost like the same. We were talking about like this whole structure right here that started with this vibrational point. This is where vibration came, and it started to deplete demand and start improving supply. We need the conclusion of that, preferably some kind of capitulation, climactic aggression. And then all of this uncertainty with Iran maybe could prolong like us being in the trading range. Plus, that could also indicate some kind of troubles in the economy, Bruce, that we're basically hearing today as a message from different sources.
Such a great analog. My God, wow. It's and of course, that's around the time that we started WMD.
We did, yes.
Yeah, because I can remember marking up those point figure charts to show. And but the thing that somewhat stands out to me here is this area from 9 to 11. It looks a little weaker now than it did then.
All right, guys. So I think, memorize this.
It's around
picture.
the time that we started WMD.
I think I'm gonna take a screenshot of this here. This is the future. This is your future. This huge trading range in the S&P 500. Holy shit! Nasdaq, S&P. Oh my God! It's gonna look like this now. Between what? 21,000, 20,000, and 26,000 on the Nasdaq 100. Oh boy, that's gonna be good for trading though. But if you're still in oil, no worries. Oil will just keep going up and up and up. I'm sure the oil ETFs, not crude oil. Crude oil, I think, is now going to be moving up and down, averaging about maybe $80 a barrel. I think from now on, until the next event pushes it up even further. Some other shoe will drop maybe in 2027, but I don't know what that would be. That'll be the end of it, I think. That'll pretty much be the end of everything. That'll pretty much be the start of the recession. All right, so take a screenshot here. All right, good night, all. Good night. 2 hours, 30 minutes. Perfect. And we'll see tomorrow. Tomorrow I will be on. Maybe if I do a tomorrow show, it'll just be before the nap stars. Okay, over here. So go to that link over there, or Anita Bong hit. I'll probably do something. Boyd related. I don't know. Maybe tomorrow morning I'll do it instead. I don't know. I haven't decided. Oh, But as far as the market is concerned, I don't think anything's really going to happen tomorrow. We'll be pinned. The market will try to pin us into some kind of range immediately, and there won't be anything. Unless something's happening overnight right now. I don't think so, right? Let's see. Let me check. Nope, looks all quiet to me. Yeah, I think it's quiet. Nothing's going on. Nobody's doing nothing. Okay. I mean, pre-market will open in about like a couple hours. Yeah. So I don't know if nothing's happening now. I don't think so. Europeans should be doing something if there's something going crazy. But who knows? Maybe once pre-market opens, everything goes wild again. Fuck. Oh, like that, huh? Yeah. Nothing. I don't see nothing. All right, guys. And then over the weekend, I'm going to have to prepare to make my Substack. That'll be introduced next week. So if the market is going to puke like this, I'm going to give you levels of all the stocks I want to buy and buying it up. So there we go. And what prices you want to get it. So if you want to follow me with the boomer stocks there we go. We can start doing it next week, or at least planning to if nothing happens far enough next week. I don't know. It'll be spring break too, right? So yeah, I think you guys should have plenty of time, right, to watch my shows on spring break. All right, guys. I'll see you. Good night. Good morning. Guten Nacht. Guten Morgen.